What if I told you your credit score is not the only thing that determines whether or not you can buy a house? In fact, I see buyers every week with great credit scores that still can't buy, not because of the credit score, but a different number, a number they've never heard of. It's called your debt to income ratio. Today, I'm going to explain not only what it means, but why it matters and how you can improve it before you apply for a mortgage. I'm Nikki Rogers with Team Nikki Rogers, located here in New Bern, North Carolina, proudly serving Eastern North Carolina. Additionally, we are licensed in Virginia, North Carolina, South Carolina, and Georgia. While good credit definitely helps you, it's only one piece of the puzzle. Lenders additionally want to know one very important thing. Can you comfortably afford your monthly mortgage payment? And that's exactly what your debt to income ratio helps us determine. So here's the question. What exactly is debt to income ratio, also known as DTI? Think of it like this. Every month you have your money coming in that you've earned, as well as all your bill payments going out. Your debt to income ratio simply compares these two numbers. It tells us what percentage of the income you're making is already obligated and committed to other payments before you take on a mortgage loan. So what does that number mean? The lower the number is, the more buying power you have. Here's something that surprises a lot of people. We're not looking at the total amount of debt that you owe in total. We're looking at the monthly payment. Where do we get that monthly payment? Your credit report. So what are we looking at? We're looking at auto loans. We're looking at personal loans. We're looking at your minimum payment on your credit cards and revolving lines. We're looking at student loans that are reported on your credit report. And additionally, we're going to be looking at child support, alimony, and separate maintenance. Biggest question I get right around here is, do I need to include my rent payment? The answer is not for the debt to income ratio, because the assumption is you're going to be replacing the rent payment with your mortgage payment. We do, however, need to know that amount because it also could strengthen your file. Now, let's talk about how we calculate this number. We're going to make this real simple. Imagine your monthly debt payments add up to $1,500 a month, and your gross monthly income, that is before taxes, is $5,000. You divide 1,500 by 5,000, and that equals 0.30, also known as 30%. That is your debt to income ratio. That is actually considered a very healthy DTI. Now remember, we use your gross income, not what actually hits your bank account after taxes. What numbers should you aim for? So before we get into this next topic, there's something really important to know. There's actually two DTI numbers. The first number, which is what we've been talking about, is your total debt to income ratio, which is bringing in everything that we talked about. Now there is a second DTI, which is only the housing payment. Now that was already included in the first large DTI. So we're going to stick with that number, total debt to income ratio. If your total debt to income ratio is under 36%, you're in an incredibly strong position. Between 36 and 43, you're generally still meeting all lending guidelines. However, this could mean we have to take a closer look at your entire financial picture. Now, 43% up to 50 can become more challenging depending on the loan program. And at this point, we would take into consideration your entire financial picture as well as any compensating factors. This is when the human element comes in for mortgage lending. And if you're over 50%, what that's telling you is over half of your income before taxes is going to be going towards your current obligated debt and that new house payment, which, let's be honest, that's a lot. Now, here's something that's important. These are not hard rules. Different loan programs have different guidelines, also allowing for flexibility. And that is why every buyer's situation is different. It's super important that we have a conversation first. The debt to income ratio requirements on a conventional loan are very different than a VA loan or even an FHA loan. So what if your debt to income ratio is higher than you'd like it to be? And you know that you can afford the payment, but the math isn't mathin'. What are we going to do? The good news is there are several ways to improve it. The first thing I'll tell you is if you have an installment loan, meaning that you have the same term and payment every month, that would be an example of an auto loan or a personal loan from your bank. If you have less than 10 payments left, we would really want to look at that because depending on the loan type, we could exclude that number from your debt to income ratio. So if you're at home and you're doing your quick math, you would think you don't qualify, but we know that you could qualify. Additionally, what I see a lot of clients do is debt consolidation. What's happening is we have multiple credit cards that are getting added up. So what we're doing is we're seeing folks go out there and get debt consolidation loans that pays off all of your unsecured debt so you have one fixed payment. Another tip, your student loan. We recommend that you make sure that you have some payment reporting on your credit report. Because if the payment is already reporting on your credit report, that is the payment we use. Otherwise, each loan type has a different guideline based on your student loan and what we need to assign you as a payment. For example, credit report says zero payment. We can't use zero payment. Sometimes we can. We got to figure out if we can, and if not, what that percentage will be that we assign as a payment. Again, it's something you may not have written down on your chalkboard, and it's something that's going to come up. Another tip I would give you, if you have money, liquid assets, and you want to start paying something down, what's the best thing to do? My first recommendation is going to be the highest interest credit card, because as you pay that down, that minimum payment that we count against you is going to go down significantly because you're paying so much interest. Another idea would be, again, if you have a loan that you know has 14 payments, let's get that knocked down to under 10 because that could put you in a situation where we can exclude that payment. And of course, income. If you can affect your income, if you can increase what you're making, do it. It's part of the equation. The important thing is don't assume you won't qualify. Most buyers do qualify and think they don't. The most important thing is this: talk to me. Because if you're not ready right this second, I can get you ready. Just like we work on credit score and teach you about credit literacy, we're also going to talk about your total debts in and out and what is comfortable and affordable. If you're thinking of buying a house in Eastern North Carolina or any other states that we are licensed in, let's have a conversation now. Let's go ahead and look at your credit profile. Let's go ahead and look at your debts. And let's go ahead and confirm what your income is going to be over the next 3 years. These are all important factors, and you don't know what you don't know. If this video helped you understand your debt to income ratio better, please like the video, share it, subscribe. And if you have any further questions, comment below. I'm happy to explain anything else further. I'm Nikki Rogers with Team Nikki Rogers, and I'll see you at the next video.